Hello, can you hear me? All right, everything looks good. Keshav, welcome. I love Keshav, welcome. I love to see the speakers joining first.
It's always a good sign.
Yeah.
How have you been? It's been a while.
It's been a while. Yeah, I've had a bronchitis for the past like 3 weeks, and it's finally kind of getting over, but I'm probably going to be muting every once in a while.
Okay.
But yeah, how's the Facebook and Amazon clubs going?
It's good. We just got off the built-to-rent presentation for the Amazon Club.
All right. Well, people should know here that we have finally arranged to make this meeting available to people that have either retired or are going away to different companies. In other words, this is now a public event. And this is still the Intel REI Club. I don't know if we need to rename it or exactly how that's going to work, but people that are not necessarily Intel internal can also join this meeting, and they're doing it through the Facebook group.
That's really cool. You opened that up. That's really cool.
Yeah, we have to talk more about the logistics of that.
Yeah, I want to keep it as simple as possible. You know, this is the Intel Club. I'm just going to run it at the same time, same everything, and just drop a link into Facebook for people who want to join that have been elsewhere. But if you're interested in this event and where it is on Facebook, here's a link to it. You can see Keshav's wonderful face there. Keshav, did you get to see the little graphic I put together?
I did, yeah.
Okay.
Yeah.
Great. Welcome, everybody. This is the Intel REI Club. It's also being advertised through the Real Estate Investing for Professionals group on Facebook. And my name is Daniel Homland. This club has been going on for over 3 years. We should have done something for our 3-year anniversary back in September. I have to think about that. Maybe we could do something at the beginning of next year just to celebrate the new year. I've been thinking about doing a book giveaway, but I'd love to hear everybody else's ideas about what we should do. If there's something, you know, fun that we could do as a club, just to celebrate being around for 3 years and starting a new year. If it's a book giveaway, if it's, you know, some sort of interactive session rather than just having a speaker on, let me know what your ideas are. I'm always open for ideas to make the club more interactive. And of course, thank you to everybody who's sharing their video. I love that too. Feel free not to share your video, but it's always great to see people's faces as well. Yeah, Glenn. All right. We'll wait just a few more minutes. I'll actually share that link that I have to the Facebook group with Keshav here. So if you are interested, you can find this event through this particular link with looking for this club here. All right, and we'll kick it off in about 2 more minutes. Wait for a few more people to come in.
You happen to be free tomorrow at 7 a.m. your time, Daniel? Misi and I are going to be talking, if you want to hop in.
Maybe, I suppose.
It is last minute and early in the morning for you, I understand. And you're coughing a lot.
Yeah, no, I can make that.
Okay, I'll send you the invite here. No pressure though. Get your rest.
All right. We'll wait just a few more minutes. We've got 60 people here. And let's start off with, do we have any opens? Are there any topics that somebody wants to talk about? I know, obviously, there's a lot going on in the economy right now. We're going to bring in some, I've just lined up a couple of market experts. So in the past, we've had realtors come in from California, from Portland, and from Arizona to come and give a local market update. We've started scheduling those again. Our local market update for California, I sent the calendar out and she actually booked a fair ways out. It's going to be in February of next year. But we'll probably get the Portland and the Arizona updates to be a little bit earlier than that. In addition to that, we've got some of our previous speakers coming back. Whitney, who came and spoke to us just a few days ago, is going to come back to us and speak about car washes. And we have a variety of other people actually here in, let me pull up the, actually, I'm not going to pull up the Intel meetup.intel.com site here. You guys can go to meetup.intel.com and see who's coming up next. All right, looks like we're getting a quorum in here. Keshav, welcome back here. I met Keshav, what, has it been a year and a half now or so ago?
Probably, yeah. Definitely
Yeah.
at least a year.
Okay. And he has been one of the people that have been helping to revitalize other real estate clubs that are going on in other companies. Keshav, you now run the, or at least are helping in the leadership team of the Facebook and Amazon groups. Is that correct?
Yeah.
How are
yeah.
you doing both? I just out of
Uh,
curiosity. I know you
yeah,
transitioned
well,
your job.
I work at Meta, so that helps me run them there. And then Kunal will help every now and then. And then on Amazon, one of my good friends, John, still works there. And so he helps me organize it. And then I'm able to hop on.
That's excellent.
Yeah.
All right. So why don't you go ahead and give a little bit of your background. And today you're going to be talking to us about build to rent. And I'm actually very interested in this particular market and your views on it. Obviously, I have some concerns about the market, which I hope you'll address, and that is just the rising cost of goods in building new construction. And but go ahead with your presentation. And if anybody in this group or on Facebook has questions, go ahead and just put them in the chat. And I will judiciously interrupt Keshav, and we'll get those questions asked. So Keshav, welcome to the group.
Sounds good. Thanks, Daniel. I appreciate you having me on today. Hey, everyone. Happy Friday. Today, my name is Keshav Kalor. I'm joined here by my partner, Andy McMullen, and we're here to talk to you about build to rent. We're excited. It's a new asset class, and we hope that by the end of it, you're just as excited as we are. So here's our roadmap. We'll talk about, hopefully 30 minutes or so. We do love talking, but we'll get into introduction about ourselves, what we do, what is build to rent, why does it make sense now? Is it too good to be true? Try to look at it objectively as smart investors and go through a case study of what these opportunities look like. Real quick disclaimer, we're not investment, tax, financial, or legal advisors. Everything here is for educational and entertainment purposes only. Please do your own research and due diligence before making any such decisions. So quick introduction about us. My name's Keshav. I'm the founder of Clive Capital. We help busy everyday investors passively add real estate to their portfolio. This is a pretty smart crowd here, especially since Daniel's been running it for 3 years now. So you guys are all experts for sure. I'm not going to go into the advantages of real estate, but our experience, and most of this is Andy, 25 plus years in the industry, over $750 million of project value, $130 million in equity raised, and over 2,000 units. Andy, what else would you like to tell us about yourself?
Oh, yeah, so I'm grateful to be here. Thank you, Daniel. Thank you, Keshav. What a great group. It's really a privilege to be talking to busy professionals about this thing that we love. I started off, as Keshav mentioned, I don't think it's quite 25. Don't age me that much. It's pretty, over 20, let's say, in between. But we did some development, mostly in Venice Beach, California, in San Diego now. And then we kind of evolved into doing a lot of multifamily projects on the development side and the acquisition side. And then probably about maybe 4 or 5 years ago, really started to focus a lot in the Southeast because we felt like California was going to be a little bit less predictable, more difficult to maneuver. So I'm really excited to just bring the built to rent idea to people and kind of get some feedback. So thanks, Keshav.
Yeah, let's get into it. So introduction, quick business strategy. We are a syndication firm. We invest in apartment complexes, 75 units. Now it's probably more like 100 units plus, and in land where we can build 100 homes or more and rent them out. That's the build to rent concept, which we'll talk about today. And we're primarily in the Southeast with landlord-friendly markets and all the factors that you look for in a good market, right? Population growth, job growth, etc. Current portfolio, 300 apartments in Houston, 98 apartments in Lafayette, Louisiana. This is built to rent. We'll be talking about this. And then coming up soon, 158 homes in Alabama. Again, another built to rent project also. So what is built to rent? Built to rent is single family homes built in communities, but instead of selling them to people like you or me, you rent them out instead and manage it as one centralized portfolio. So instead of managing, something on the east side of Seattle, west side of Seattle, north, south, everything's in one central location, a lot easier for a property management company to take care of. Another way people refer to built to rent is as pulled apart multifamily or horizontal multifamily. And it's really the best of both worlds, both apartment living and home living. And we'll get into this more, but you have amenities and a similar sense of community as you would in apartment complexes, but you also have more space than you would in an apartment. Your rent is cheaper than living in a single family home currently as interest rates rise. So there are a lot of benefits that this asset class draws from. And Andy, again, feel free to interrupt me at any time. Or Daniel with questions. So here's the build to rent process. We can break it up into 3 stages. So we'll walk through it from the beginning, like when we first look at a piece of land all the way through a finished subdivision, homes, renting out to happy families. So first, we'll take a look at the land and the market, right? If we like what we see, then what we'll do is place the land under an option contract. And you can think of this as hard money. So in some land we're looking at coming up, I believe, 30 or 40 acres where we're going to build 200 homes. The total land cost is about 1.8 million. And we're going to put 600K down. But we're not going to pay that up front because we don't know if the community or the city officials like what we have in mind for that piece of land. So what we're going to do instead is put the land on an option contract, meaning we'll pay $20,000 to $40,000 and say, hey, if everything goes well with the entitlement process, if the city likes what we're doing, if it's feasible for us to build on here, there's no, crazy marshland, wetlands, endangered species we have to worry about. If everything checks out and we can implement the vision we have for this land, then we'll go ahead, exercise the option contract, pay 25 to 30% down for the land and borrow the rest from a lender. So by the end of phase 1, you'll have talked to the city, you'll have had all your government meetings, your meetings with engineers, and your sanity check should be complete, right? You should either know I can build here with what I have in mind for this community or I can't. And built to rent is great because once you have step 1 or stage 1 completed, you have a complete product technically. You have the land entitled and you can hand it off to someone else and say, hey, this is what the city has approved it for. I don't want to build it out. I've already made my returns. You can go build it out. So you can exit right after stage 1. And stage 1 is the riskiest because you don't know, whether the city's going to like what you're saying or whether the engineering studies are in line with what you expect. So there's a risk, but there's also a higher reward because of that. And that process usually takes, 6 months in the markets we're in the Southeast, at least. We're allowed to move a lot quicker where, Andy in Venice Beach years ago, he would have probably had to wait at least, a year and a half, 2 years to get through that phase. And correct me if I'm wrong with the numbers.
Yeah, no, I think there's a good question about timeline. So, I mean, the acquisition phase can run, a gamut, and there's a question about options. In the Southeast, we can tie up the land with options. I think, we're looking at a deal in Chattanooga, Tennessee. The land's maybe 45 acres. They want 4 million or something for it. We're probably not going to be able to just option that land, right? We're going to have to we know enough about it. We're gonna have to do our due diligence. We know we've got a phase 1, we know we've got a phase 2, which is basically just environmental reports. So we can decide whether we move forward or we don't. But in many cases in the Southeast, land is relatively inexpensive, impact fees are lower, and we can option, from $10 to $40,000. But to answer the question about this, so the phase of after the acquisition, so let's say we put the option down, we take about 6 months or so, maybe 4, to do the entitlement, right? And then the engineering and architecture drawings, all of that is after we basically buy the land. So let's say from day 1 option, 6 months to finishing up the entitlements, we're pretty comfortable that we can get this deal done and we can execute on the vertical and horizontal. Then we'll buy it. So in this particular case, maybe Foley is 1.8 million. Then to do the horizontal and infrastructure is we'll get into that a little bit, is another, let's say 6 months, 6 to 9 months. And then our vertical build, which is the units themselves, that we would take anywhere between 10 to 20 a month, depending on the market.
Yeah. So getting back into phase 2, that's at that point, whether you bought it from someone else or you finished phase 1 yourself, you can begin the construction here. And that's, like Andy said, takes 6 to 9 months. This is where you're building the roads, the sewers, the utilities, everything, that goes horizontal. And this is less risky than phase 1, and because of that, less reward, but it's riskier and higher reward than phase 3. Once you finish the horizontal infrastructure, again, you have another point where you can sell it off to someone else. Maybe you don't want to build the homes out, you sell it off to another, development group, and they'll actually build the homes. So there's, exit point 2. Phase 3 is where you start building up the homes. Let's say we're building 100 homes in Louisiana right now. We'll build them in groups of 10 and rent them out, right? So that we can get cash flow as we build them out, instead of, building a portion of every one of those 100 homes. By the end of phase 3 is where it gets exciting, right? So here, once you have stabilized your community, you have these homes rented out, families in there, happy and everything, you can do a couple of things. You can sell it to an institutional investor like Blackstone or someone like we'll talk about in a few slides. You can break off the development into pieces, maybe 10 homes, 20 homes at a time, and sell it to different groups. Or you could refinance your investors' money out of it, and hold the cash flowing development for decades to come and really create that generational wealth that we're all in real estate for.
So it sounds like there's multiple exit plans and multiple strategies here. And one of the first questions that we had in the chat actually was around, is this a build to sell model or a build to cash flow? And you went through a lot of scenarios here. What's the happy path? What's the ideal path?
Andy, do you want to take this one?
Sure. Yeah, it's such a good question because, each project is a little bit different. So the kind of, the DNA of the Lafayette project was really, let's build these 10 a month, about 98 units. Let's stabilize them. Let's sell within 3 years, right? So stabilize them, sell them to another institutional buyer, another multifamily buyer. They're individually platted. We could cut them down in groups of 10 and sell them off. For Foley, Alabama, Chattanooga, some of these other projects that we're looking at, it would be a longer term hold, right? So we would build them, we would stabilize them. We can't underwrite for refinance, but hopefully we'd be able to refinance, give back some of the capital to the investors and hold them on, and not in perpetuity, but as long as we can. Daniel, I think we're in the business of trying to build legacy wealth, and we feel like the benefits of these newer projects, can sustain, long-term holds.
Gotcha. So some of them are turnkey that you'd be selling off once they're fully stabilized, and some of them are long-term cash flow. Great.
Right. But all of the projects we would stabilize with renters, right? We wouldn't develop them to sell to individual buyers. We could, because they're individual platted, but our goal is to stabilize them, get renters in there, Now we've got the NOI, right? The cap rate, the valuation that we've created, and then we would potentially sell it to a different institution.
Okay. I wanted to ask a quick side tour question. You mentioned a phase one environmental study, and some people here might not be familiar with that term. Can you describe what that is really quickly?
Yeah, I mean, in its simplest form, you know, if you bought a property, and let's just say before we even put our option down, we want to have like an initial environmental study. So we want to know, was the property at one point next to a gas station, right? Or is there potential environmental issues that could prop up, you know, sometime during our construction period, right? And then phase two would go even a little further, right? Where you'd have basically guys coming in and checking soil, right? And checking even a little bit further on testing. So it's really just, if you think about from an environmental point of view, what are all of those potential issues that you could face, you know, throughout the development of your project? And if you can mitigate those risks early on, you've got a much more likelihood of being able to build a successful horizontal project. And you're still going to have to get engineering and all of the rest of it, but that's a big part of it, is the phase one. That would maybe a few $1,000 in some cases, you know. Phase two is more expensive.
Okay. I'll let you go on with your presentation.
Keshav hates how much I talk, so he's probably like, skip ahead. Go ahead.
No, you're good. You're good. So that's how build to rent works, but why does it make sense now, right? And there's a couple different angles that we need to approach evaluating this new asset class from, right? So here on the left, we're going to take a look at institutional investor demand. Build to rent as an asset class really started taking off in 2018, 4 years ago. And at the time, these build to rent communities were trading for 5.25 cap rate, and each home was being bought at a median price of $220,000. Fast forward 4 years later, and obviously because of economic conditions, increased competition, inflation, cap rates have compressed to 3.25, but the home prices, the home prices have almost doubled to nearly $440,000. And these aren't being bought by people like you or me, right? Institutional investors are buying these communities up, and that $440,000 price tag is 20% over the $368,000 price tag that your median, your average home buyer is paying to actually own the home. So institutional investors are bidding out retail home buyers in build to rent properties. And here on the right, or I guess let's go back to institutional investor demand. Quick note, currently institutions own about 5% of all rentals in the market, according to a Yardi Matrix study. And that same study predicts that by 2030, institutions will own 30% or more of rentals. And you might think that that's crazy, but this past year so far, every fourth home, every 1 in 4, was bought by an investor. Because obviously everyone realizes, right, until we get to Mars or wherever we're going, no one's creating any more land. Housing is going to get more and more expensive. So they realize that there's profit to be made here.
And just for reference, Wall Street probably owns about 50% or so of the multifamily market, right? So you can see that there's a lot of upside here for them. We're probably in the early innings of build to rent trend.
I know that there's a fair amount of political resistance to selling directly to investors. And I wanted to ask you about what advantage in your business model does selling to an investor have rather than just selling it to individuals?
Oh, you mean the individual units? So let's say,
or maybe somebody who, I guess you could sell to an investor who would buy a block of 10. Why institutional versus personal?
Yeah, I mean, I think so. I think the political point of view is interesting because, if, as Keshav said, we're talking about a really small sample size of rentals, right? So one could argue that if they controlled 50% of the market and they just keep pushing up prices, that this is really kind of affecting people that wanted to buy their first home. But what we're seeing is that's not the case in most markets, right? You could still buy your single home. What I think we're seeing more of is that people want to live in these communities because they've got their new tech, they've got their green spaces, they got their big backyard. And so the affordability gap is not nothing, right? It's a real thing. It's interest rates go up, right? And you're paying $850 more for your mortgage payment, et cetera, or for your mortgage payment and all the expenses associated with owning something, as opposed to your rent. You're going to take the rent with the new stuff. But I don't think the institutions are responsible for that, right? The interest rates are the interest rates. So I think the political part of this is a little overblown at this point. I mean, maybe as we get further out, you know, the mom and pops that are investing in, you know, the CalPERS or CalSTRS of the world are benefiting from the run up in interest rates, right? And so their yield is increasing, as well as the valuations are increasing. But you know, there's going to be some point, Daniel, I think, that you will see, you can't just keep pushing up rents, right, forever, right? So there's going to be some regulating back down, and some of these newer projects in some of these markets are probably going to be suffering a little bit. But I think the political part of it at this point is a little bit premature. Anything you want to add on that, Keisha?
No, I think you hit it on the head.
You know, I'll let you go on with your presentation, but I kind of want to circle around. You mentioned regulatory pressure, and I want to get your picture on that, but we can hold that till the end.
Okay, sounds good, Daniel.
It's your show, Daniel. Whatever you want. I mean, if this is boring you and you rather just have the questions, we could do the Q&A. Right?
No, I'm just trying to make it a little interactive for everybody.
I love it.
But I also definitely want you to get through your material.
Yeah, sure. We'll definitely leave some time at the end. On the right here, we're looking at the 30-year fixed rate mortgage, right? Back towards the end of last year, it was at 3%. Now it's closer to 6-7%. What that does is that pushes your monthly mortgage payment up. Even though the housing market is cooling, now you're paying hundreds of dollars more on your mortgage payment, and it is cheaper to rent than it is to buy. And that's the case in 38 of the 50 major metros in the country right now. Right. I think we'll go into a little more later. I don't want to get too repetitive here. We're going to continue on that theme of institutional investors, right? Oracle of Omaha here, back in an interview with CNBC in 2012, said if he had a way of buying up a couple 100,000 single family homes, he would load up on them. And while we don't have the balance sheet of Berkshire Hathaway, the build to rent is a way to invest in hundreds and, you know, hopefully soon thousands of homes like we're doing right now. Goldman Sachs granted a $300 million line of credit to Fundrise, the crowdfunding platform, in July of last year, again, to go out and buy single family rentals. And lastly, institutional investment in single family built to rent in 2022 so far alone has already north of $60 billion, right? They realize that this home shortage supply, wherever you think it is, 2 million, 3 million, 4 million, that if there's demand in the market for a certain product, then investing in that product is going to be very lucrative for them. Now we're going to contrast it to a business model that you all are probably more familiar with, which is your bread and butter multifamily value add commercial real estate syndications. That was a mouthful. But it's harder to find these value add properties now, right? There's not that many left with those original 80s, 90s cabinets, appliances, flooring. They've already been renovated a bunch. And even if they haven't, you can only renovate up to a certain point, up until the market can't handle the rents that you're trying to push. You can't go into a market where the median income is, you know, $40,000 a year and just put granite countertops and stainless steel appliances and the latest smart home technology and expect people to pay for it. So at some point, it's necessary to not just renovate existing inventory, but it's also necessary to add new inventory. And that's what build to rent is doing. So here's that concoction of factors we were looking at, right? There's really three parties who stand to benefit from build to rent. So one, the tenant base, right? Millennials make up the bulk of the entry home buyers in the market right now. And they've gone through the 2008 recession, the COVID recession briefly, the hiring freezes we're seeing right now. And they have student debt, right? Rising cost of living. It's a lot harder for the home buyer today, the millennials, to buy than it was for their parents. And there's that affordability argument that we were talking about. But one of the positives of COVID, right, it showed us a world where we could work from anywhere, anytime, and still get our stuff done. So millennials like that flexibility. They don't want to be locked down to buying a home in, New York, New Jersey, if they could try out New York for a few years, LA for a few years, Austin for a few years. It offers them more flexibility in their life. Not only that, but people like having pets, right? Dogs, cats, and then, they'll have kids too. And built to rent, we have these spacious backyards, like the ones we're building in our projects right now, so that their pets and their kids can run around. And it's a lot harder to do in an apartment complex. So you have that, aspect of spaciousness and privacy as well. On the city official side, city officials, government officials, they love built to rent because of the amenities and the aesthetics. You're not just plopping down another, vertical apartment multifamily project with amenities. You're giving people those backyards, the ponds, the clubhouses, the pools, but you're also blending that with a lot of the benefits that you get in living a single family home. And lastly, investors love it because of your typical economies of scale that you see in commercial real estate, the lower maintenance costs, because this is a Class A product with the latest technology. Your ratio, your operating expense ratio is usually around 30 to 40%, where that range is probably 10% higher for multifamily because it's older product. A lower turnover rate, which Andy can speak about, right? Stickier tenants.
Yeah, so Kish, there's a lot of good questions here, talking about, referring to kind of what you were hitting on.
Let's get them, yeah.
Yeah, I mean, because I don't know how much time do we have with you guys today, Daniel?
We go till 1 o'clock
Okay,
Pacific time.
okay, all right.
So 1 hour in total, including questions and everything.
Yeah, so I thought that was a good question that is it Ain had? Ain? About just the backyard. So, for Lafayette, a lot of the projects that we're competing with, they might have a pool or a clubhouse, but they have really small backyards. And so we're talking about maybe building 20, 30 foot, backyards, not huge, but good size for, their dog or two. And a lot of green spaces, right? We want to have walking trails and dog parks and things like that. With the project we're doing in Foley, Alabama, and when we're looking at Broussard, we would have kind of much larger backyards, but we'd want to have the pool and the clubhouse, right? Because we're going after $2,200 to $2,400 renter. So I hope that answers your question. And then, Keisha, this is a good one for you. Is you consider rent to own for those properties you hold for cash flow?
Yeah, that's definitely, as developers and investors, that's part of creating that legacy wealth, passing on assets to your children or loved ones. Once we're done with the development, we'd love to refinance our money, our investors' money out of it, and then hold it for decades to come. Andy has a phrase that he loves, the golden goose. So if you have a asset that's producing 10% cash flow, 12% cash flow, and it's really hitting its stride, why sell it off then? And instead, get hit with taxes, having to find another property, when instead you could just keep it, build up that passive income that we're all in real estate for, and move your capital on to another project.
Yeah, I mean, I think a lot of people, they like the idea of maybe just accelerating because you get the benefit of, cost segregation. And if you accelerate, you got a new project, now you got a new write-off, etc. But my view on it is, and there's properties that we own that people would come for my head if we sold them, right? Because they're giving them a cash flow return, and they have to figure out what are they going to do with it, pay the capital gains or trade into something else. And now you're trading into something else where interest rates are high. So I think, ultimately, if we can hold in real estate in this game, I mean, everybody has their own, you probably should mix it up a little bit, but I think a lot of these are really cash cows because you got interest rates, you got inflation, you got rents that are increasing, and you've got kind of multiple exit strategies, but then your expenses are lower too, right? Because it's newer. So your expenses, like in that 70, 80, 90s build, you might have, 50% you know, in these newer builds, 35% operating expenses. So they make for cash flow.
For a really quick question, and maybe this is a little bit longer, and you might talk about this later, but for investors, is there a difference in the investment return in investing in just like their own single family home versus investing in a larger portfolio of homes that are being built, you know, through a professional group like this? What are the differences from an investor's perspective?
Yeah, we'll be getting to that later.
Okay.
Yeah. Are there we can hit the other questions though. I see we have 22 messages here in chat.
One quick question is, do you vary the floor plan of the models homes?
We do. We have different front elevations, meaning when you look at the home, you know, not face to face, but, you know, front on, we'll have different elevations for that, what the front of the home looks like. In our upcoming project in Foley, 150 homes, we have a 2-bed, 2-bath, then a 3-bed, 2-bath, then a 4-bed as well. I don't know if that one's 2-bed or 3-bath, but we definitely mix it up so that we can hit all segments of the market, right? You'll have families, you'll have bigger families, then you might just have couples. So we want to diversify.
Okay, great. I'll let you continue on.
Okay. So when we look at the tenant base benefiting from build to rent, the government, city officials for us providing that housing and quality of living, and investors, in the words of Michael Scott, it's a win-win-win.
No, Michael Scott. Wise man.
So that's how build to rent works. Now we're going to get into, and you know, that's a lot of technical details. We'll cool off for a bit, look at some pretty pictures. So this is a home from that 98 home project we're building in Louisiana right now. You can actually Google this address. It'll be up on Zillow. So here's what the homes look like. They're 1,200 square feet. This is obviously not finished. We're going to paint the homes, as you'll see in a few slides.
So where's the sod? There's got to be better pictures, Keisha.
Yeah.
Love the sod. I want some green there.
Yeah. We'll get some new pictures in there. But this is a 1,200 square foot home, 3-bed, 2-bath. And as you'll see here in the next few slides, very modern finish, right? This is the living room here on the right. Different view of the living room, the kitchen.
And they look really spacious, right? But really about 1,300 feet, so we can build them really efficiently.
Yeah, on the outside, you wouldn't think that they're, you know, they go this deep in, but they do. Here's a rendering. Here's some color, right? This is what we want. This is what we have in mind for our community. We're working with a 3D rendering company, Applet 3D, to give both our investors and future tenants an idea of what they're investing into or going to be renting into. So you see our homes here, all 98, right? Gated entrance, that pond, that dog park we were talking about, the jogging trails. So here's the numbers that you were asking about, right, Daniel? So this is for our upcoming project in Foley, Alabama, and these are just approximations, right? That's all underwriting is, just projections. But year one, let's say you invested 100K for easy numbers. Because of rising interest rates, you're going to see very limited cash flow. 6 months ago, when we were taking a look at this project, the numbers were a lot healthier because our construction loan was only like 5.5%. Now that's up all the way to 9.75%. So that's, you know, that's really going to cut into your bottom line. So your cash flow in year 1 and 2 is going to be pretty limited. Year 3, we don't underwrite for this, but we would hope that this is a realistic scenario. Between year 2 and 3, you would refinance once you've stabilized the project, once your renters are in there and you have that income coming in. And we expect to pull out 40 to 60% of our investors' capital. And then you sit on, you know, single digit cash flow returns, again, year 4 and 5. And then your big profit comes when you sell, right? So if you choose to sell. At that point, we're projecting a 57% return on investment. And putting those numbers together, that's 109% return over 5 years. And that's not including a lot of the risk mitigants we baked in, which we'll go into later. So at the end of the day, I guess it's really a question for the investor themselves, right? Would I rather invest with a group that's experienced, who's operating at scale? Because we know that, if you're buying a single family home, if you're not managing it yourself, you're probably paying someone else 8 to 12% to do it. We're paying our property management company here 2 to 4%. So because you're playing at a much bigger scale, people listen and your costs come down per unit. So it's either you get 109% return over 5 years for not much work on your part, or if you love real estate, you like going through that process and working on it yourself, then the single family route's obviously a great option as well, or a smaller scale project.
Hey, Keshav, can I just interject here and say, I like that you're talking about the numbers, but can we limit the talk to, general returns and not returns for a specific project?
Sure thing.
We'd like to keep it educational and not focused on a particular investment opportunity.
Right. Yeah, no, these are just sample numbers for sure.
Okay.
Basically cash flow is going to be limited years 1 and 2. You can, hopefully expect to refinance between years 2 and 3. Your cash flow is going to be a little limited. It's going to be better, single digits after that. And then your big profit is going to be on sale if you choose to go that route. So after all that, right, is built to rent too good to be true? So here are some of the risks and the risk mitigants, right? The risks with built to rent, obviously construction is inherently riskier than renovation. Second, like we saw on the previous slide, especially in this high interest rate environment we're in, cash flow is very limited in years 1 and 2. And lastly, construction loans are typically floating rate, meaning if rates go up, your construction rate loan is going to go up as well. If they go down, your loan rate is going to go down. With that being said, there's obviously ways you can mitigate it too, right? And we like to mitigate it 6 to 7 ways usually. We're starting with that construction loan. We'll buy an interest rate cap if the environment makes sense to do so, like it does right now. So we're capped out at 9 3/4 on our construction loan, for example. Second, as with any other commercial real estate deal, you want to be conservative on your exit cap rates and the rent growth and the rents that you have in your pro forma. Specific to construction, you should have your contingency reserves. So construction's, almost always delayed and over budget. You want to avoid going back out to your investors and doing a capital call. So you just want to pad your construction budget, typically, 5 to 10% extra, just to have some more money in the bank for that rainy day that comes around. Then as far as returns for investors, usually in multifamily value add deals, what you'll see is you'll have a preferred return and it's cumulative and accruing, right? So let's say you have a preferred return of 10%. You'll get 10% year 1, and let's say year 2, you get the cash flow is 12%. You'll get 10%, and the remaining 2% gets split 70-30. So 70% in favor of the passive investor, 30% to the partnership. Because construction developers realize that it's riskier, instead of going into a split immediately after the preferred return, sponsors do a preferred return and a return of capital before they start sharing in the profits. Beyond that, you also have other things you can be conservative about, right? Like not including a refinance in your underwriting just to be safe, because we never know where the market's going to go. You can be safe by saying, hey, I know I can build 10 homes a month, but let's just assume I can build 6 a month and underwrite to that. So there's a lot of things you can do to make the deal safer for yourself or for investors.
We have a questions here from Pompey saying, what geographic areas would you not go into or would you not consider the strategy in? Florida was mentioned, or would you double down on this area now?
Yeah, good question, Poppy. I think there's areas of Florida I like. It's a little bit different in that it's a block build and we're usually building stick build. So, it's a different dynamic. We like Greenville, Harrison, South Carolina. We like Chattanooga. really areas around the Southeast. There was a couple of projects we looked at in Orlando. I typically like the smaller markets because I think that, real estate's cyclical. Some markets are ascending, some are descending. So I kind of like to stay in that secondary, tertiary markets where I think a lot of people, suburbanization has been going on even before COVID. Those are the areas that I really like. So I would stay out of kind of those major metros at this point. I know a lot of people would disagree with me though.
All right, and we have another question from Ashish. He says, how does the ROI of a build to rent strategy compare to, I'm not sure what horizontal and vertical, but multifamily over the long term? How do the two strategies compare? Is it more expensive to maintain, individual houses that have more exterior walls and roofs than multifamily?
Yeah, I mean, typically, so the expenses on newer build, right, are less. So your operating expenses are going to be lower. I would say in multifamily, certainly if you can find those deals, they're harder and harder to find these days, I believe. And we still love multifamily. We bought 3 assets this last year. But I think that in general, if you're going to be investing in a development, you want to be paid for some of that risk, right? So you would expect typically a higher IRR than you would in a multifamily project. And I think you alluded to, if I remember correctly, like in the phase 1, where we're just kind of in the early stages where we don't have a whole lot of, knowledge whether the horizontal is all going to work out. Then there's some risk in that particular phase 2, where we're building out the streets, roads, sewers, etc. And so each of those you would expect a little bit more in return, just like you would if you were investing in an early stage of a business as opposed to later after it had been, stabilized. Yeah, so also for round numbers, like, in the 18%, I think most people were pretty happy with a year ago. Now I think you want to have, I'd rather see investments come across my desk with a lower IRR that have just a ton of risk mitigants in it, right? That's what I would like to see.
David is asking the question, can you describe the tax implications for year 4 and beyond? And, feel free to throw in years 1 through 3 there too.
Yeah, well, so we can do, last year we had very little construction, right? So the cost segregation, bonus depreciation would be coming in for the horizontal on some of the projects or on some of the unit build. So let's say, in multifamily, you might get anywhere from that 50 to 75% bonus depreciation. And it's the same thing for development. But as you know, once you do take that bonus depreciation, the following years are very low in the amount that you're going to be writing off, right? Which is part of the reason people like to keep moving things along, maybe make an investment a year or so they can collect that write-off. But it's very similar to multifamily in that way.
All right. And at this point, we don't have any more questions in the chat. You could either continue on with some parts of the presentation, as long as they're generally educational and not about a specific opportunity. Or we could open it up to audience questions. Let people come up here.
We just have a slide here.
Okay.
Yeah, just a summary. So in summary, like right now, what we're seeing at least is a pretty good concoction of factors to support investing in construction, right? You have low supply, rising interest rates, and high inflation, institutional investor interest to buy out your investment once even the project stabilized. Millennials and renters are looking for a remote, friendly, flexible lifestyle. And as the old saying goes, your money's made when you buy, not when you sell. And we are, going into a recession right now. People are scared, and there's yet another saying, Warren Buffett, be fearful when others are greedy, be greedy when others are fearful. And that is it. So I'll just throw up our contact information, but let's get into questions.
All right. Ashish is asking, what happens if your models if home prices continue to come down?
Yeah, it's such a great question because, I've been in this for a while. And so in 2008, obviously, the water shut off for a lot of us. but those properties that continue to have cash flow, you could be paying your mortgage, you could stay in long enough. That's kind of the name of the game. So in our models, we're basically accounting for not being able to refinance, right? And still being able to stabilize the property. So if we got to pay a higher interest rate on a project or two, but we can't expect to have a refi, that's kind of what we have to do. I think the valuations on the property is probably likely that some of the homes are going to be falling in valuation on if they were to sell. However, you remember most of these are traded like multifamily projects, right? So it's based on NOI and what the cap rate. So you'd have to basically, we try to, have, a gap there maybe of the 100 basis points, 80 to 100 basis points of cap rate appreciation over the time. So when rates do fall or when prices do fall, that you're still okay with that investment that you've built out, or the model that you built out, I should say.
All right, we've got a couple of good questions pouring in here. Durval is asking, how will rising interest rates affect institutional appetite for this type of product?
Yeah, it's such an interesting time, because part of the reason that Wall Street still likes this asset class is we call it kind of the triangle. So they love that there's low supply. They love that there's increasing rents, right? With inflation and increasing interest rates, there's likely going to be increasing rents. Now, they may regulate down a little bit, but they're usually not dropping too far, right? And then the other thing is this affordability gap. And the reason that Wall Street loves this is because now they can build stuff where there's this affordability gap of $850 in difference between mortgage and rent. So I think the kind of demand is still there. And if you're a young family, I think 33% or so of built to rent communities are usually rented, mostly in ours are, young families. So couple with kids, or just a couple is another 33%. So about 65 to 70 are really kind of in that group. So like you have to have rate caps, right? But if interest rates go up to 10 or 12, there's going to be a lot of people that didn't have rate caps that were at 3% or 5%, and they're stuck with their max increase in rent. So it's going to be an interesting time. I wish I could give you more of an answer on that, but I don't know any better than anybody else.
Yeah, there's definitely a lot of interest rate risk in the market right now, and projections are difficult, and so you have to work with worst case scenarios potentially, which is why you buy rate caps, right? You buy a rate cap and your worst case scenario then. Misi has a question here, and I'll get back to William's question in a moment, but Misi has a question on what if your projections for interest rates during the hold are higher? And I want to add on to that. How long is the period for the construction loan before you do go through a refinance of the long-term debt?
Yeah, so in our case, about 40 months, and then we can get an extension. So if we have to hold it for, for instance, a couple of our assets right now, if we've got and we're there with larger banks, but let's say we have to hold it for 48 months at the higher interest rate without refinancing, we can do that. We've also kind of modeled it if we have to hold for 5 years, right, by getting another kind of larger loan that's a high interest loan, then we can still do that. So I think you got to have those kinds of sensitivity analysis. If I'm looking at a project now just as a passive investor, which we still invest passively, I don't want to see those like 17, 18s. I want to see like 15 with like a ton of risk mitigants, right? Those are the kinds of deals that I want to see.
William has an interesting question here. He's asking about, what if banks move to a 40-year loan? How is this going to affect your business?
Yeah, because we try to do, in case you might remember, we try to do a 40-year loan with but it with a HUD loan, and it was the worst nightmare ever. So I wish I wouldn't do it again with HUD, right? But if if we're talking about banks deciding to do something like that, it's a totally different story. But I'm not smart enough to predict what would occur there. Maybe you are, Daniel. Maybe Casey,
let me throw a dart out there on this. And obviously I have no more information than anybody else, but 40 years, it means your payments are going to be lower over, per month. And so
Yeah, the
potentially
amortized
when you
payment.
refinance, you're going to have potentially better cash flow for a long-term hold, if you were able to move into a 40-year mortgage product.
Yeah, most of the stuff that we're doing, on the bridge is interest only. The people that can get the HUD loans that have gone through the process, obviously it's headaches, paperwork, but yeah, imagine your cash flow. If you were to do a 40-year amortized 40-year and you were getting in the 3s, 4s, or even now, if you're getting the 6s on your 40-year amortization schedule, it's a great loan. I don't know that it's going to happen. Be interesting.
Yeah,
The person that asked the question, is that William?
it is.
Do you have some inside baseball for us? Some inside knowledge? This is going down soon?
No, I'm not sure if interest rates are gonna go down like everybody predicts. And to make houses more affordable, maybe they may stretch out the length of the
Yeah.
loan.
Yeah. All right. Ashish is asking, have you considered lowering your costs by sourcing modular homes?
Yeah, indeed. And we were thinking about it with our a couple of our projects that we got down the road. The modular, it's not that any less expensive, but obviously the time, right, which is huge for development. How quickly can you build these things? So if you can get your modular homes in and you can get them in with speed, there's a huge advantage there. With supply chain issues, we've been talking to a few people, and we still haven't had the confidence level that we're going to be able to pull it off. And I know there's a lot of people that are pulling it off, but for us, we still haven't had the confidence level that we're able to find that vendor that can help us get there as quickly as we can build them.
And Ashish has another question about, have you considered adding solar panels? And actually, I'm not sure, but in a lot of regulatory environments, they're requiring more solar panels or potentially solar or electric car hookups. And of course, there's going to be more subsidies for those sorts of things as well. So how is that going to impact your builds?
Yeah, the solars. I wish I could remember the operator. You should talk to him, Daniel. But you can make almost any deal pencil now, right? If you got solar, you can make these deals pencil because there's so many opportunities and credits depending on the market. In the South where we are, we don't have as many of those credits available. We will do a couple of we'll do some for cars, we'll do a couple of outputs, but I think there's a lot of those kinds of things that you can really boost your bottom line for investors. A lot of it, the tech involved now in managing these properties is so much less expensive. If you can have those amenities for people that can, turn on their air or the AC in the car. I mean, there's just so many, but the solar is a big money maker, and we've been kind of looking into it. I don't think it's in California, it's a no-brainer, right? Because they give you so much money to do that. In some of these other markets, they're not as friendly.
Mario's asking, what's your typical vacancy and turnover rate in a project like this? And do you have any cap on rents?
Yeah, no cap on rents, although I think there'll be a natural cap, right? You just can't keep pushing up people's rents. But in California, that's part of the reason we left. The rent control was enacted, and as it turned out, it didn't really affect much because inflation was so high. So the CPI increases were so high that it really didn't affect us that much. But I mean, I think that I don't see how some of these projects, and that's part of the reason I'm a little less bullish on multifamily, is because a lot of these deals are predicated on the idea that you're going to be able to increase rent. And, if it's been if it's been turned 3 or 4 times with meat on the bone, and you got cap rates that are coming up and you got interest rates that are this high, like at some point, this negative leverage doesn't make a whole lot of sense. So it's going to be interesting to see how long these rents can sustain itself. So I think you got to find areas where, like for us in all of our underwriting, I don't want to see any underwriting that's more than just the standard 3% CPI, even though inflation's going crazy. You still got to make sense in that box, right?
Right. It's I guess it's called conservative underwriting. Always
Right,
underwrite
what is
to
it? Like
a
we hear it. I
bad
try not to
scenario.
use it anymore. I wish there was another term that I could like just coin, so I didn't have to say
Yeah.
that. It sounds so dumb. You know?
Maybe the word for it is factoring in potentially worst case scenarios,
Right.
and if you do better than that, hey, that's wonderful. So yeah, and you're right, I don't know what the term for that would be. What about turnover and vacancy rate in these communities? Are you able to put renters in all of these houses?
Yeah, Casey, you want to talk a little bit about that, or?
And just so you know, we've got 1 minute left, and so make it quick.
Yeah, I think we assume 10% vacancy standard and turnover. They are stickier tenants than multifamily because the quality of living is better, right? Like we said, the best of both worlds and affordability, but you have that backyard, you still have the amenities. But you don't have to mow your own lawn or shovel your own snow. That's all taken care of for you. I think I don't know. I don't have numbers do you have numbers off the top of your head, Andy?
You mean for turnover? Yeah, it's about 2 times the amount of typical multifamily. So if a multifamily staying typically 18 months, most of the BTR are 3.5. Most of our leases are 2 years, by the way, for the build to rent instead of 1.
That's interesting.
Yeah.
Okay. Hey, it is now 1 o'clock. Could everybody take themselves off mute and thank Andy and Keisha for coming here and talking to us about the build to rent model?
Thank you.
Hey, thanks, guys. Appreciate it.
Thank
Thank
you.
you.
Thank you.
guys.
Good luck.
Thank you,
Thank you,
everyone.
guys.
Appreciate you sticking around. Thought we were
Yeah.
gonna lose there for a little bit, but thank you.
Thanks, everyone. Thanks, Daniel, for having us on.
Absolutely. And we will see you all next week. Same bat time, same bat channel.
Thanks, Daniel. Appreciate you.
Have
Take
a good
care,
weekend.
everybody.